Let's pose that question to Yashpal Gupta, the Chief Operating Officer of Repco Home Finance, who joins us right now on the show. Mr. Gupta, good having you. Thanks so much for joining in. There is no taking away the fact that the cost of funds for most NBFCs, housing finance or otherwise, will go up. Question mark is how worse can it get for companies with significant ALM mismatches versus maybe some of the others who don't have so. What is your thought here? Okay, so good morning and thanks for having me on the show. First of all, let me clarify about the perceived liquidity situation. I'll give example of our company. In housing finance sector, one is the liquidity which is based on the contractual obligations. So if you look at Repco Home Finance also, yes, if you look at contractual obligations, it appears that there is a huge liquidity mismatch, which we have published to the stock exchanges and the part of the annual report, that the liabilities which are maturing during this current year is about 3,000 crores, whereas assets which are maturing is 700 crores. So obviously it gives a very negative impression that we had 2,300 crores of ALM mismatch. But if you look at the behavioral aspect, which I will explain, then situation is not bad at all. For example, out of the 3,000 crores liabilities which are going to mature, about 900 crores are working capital limits from banks. Now, as we know that the banks sanction the working capital limits with the condition of annual renewal. And since that renewal was due in April, we presented it as per the contractual obligation as if they are due for repayment. But we all know for 18 years of our history and for about more than 50 years of banking system, working capital renewals are always done unless there is a big issue. So though as per the ALM guidelines we have to show it as a payment due, but actually it is not due for payment in that sense. So that 900 crores has since been rolled over. Now another thing is that if you look at housing finance companies, on paper, yes, our the average schedule of maturity schedule of the advances is about 15 to 20 years, and average maturity schedule of liabilities is about 5 to 7 years. So it does appear a huge gap. But at the same time, what we are observing is that, and it is true across the housing finance sector, that about 9 to 10% of the assets, they get prepaid every year. So if we take that into account, then the maturity schedule is only about 5 to 7 years. In our case also, we are seeing that about 80 to 100 crores of loan is repaid or prepaid every month. So if we take that 1,200 crores into account and 900 crores of working capital that has been rolled over, then the gap comes down to 200 crores, not 2,300 crores. And that 200 crores is also can be easily funded from the retained profit that we will have or the fresh lines that we have. So as far as liquidity is concerned, I can tell you about Repco, or which are the institutions which are purely into housing finance sector. I think liquidity is not an issue, number one. Now, yes, repricing risk is there because all our liabilities, even bank term loans, they are due for reset every year. Even NHB refinance is due for reset every 3 years. But at the same time, we also have a right to pass on the interest rate increase to the lenders, to the borrowers, I mean, sorry. For example, in our case, we have a benchmark rate which we call as a minimum lending rate, which is the minimum rate we charge to the lenders, borrowers, and then we add the risk premiums depending on this type of loan, the size of loan, the risk profile, etc. And that rate is reset every 6 months. So in the month of April this year, that minimum rate was 8.3%, which is the benchmark rate. I'll just finish by saying one more sentence, which as on 1st October has been increased to 8.95%. So about 65 BPS we have already passed on to the customer. So as far as we are concerned, we don't see a liquidity risk. Yes, there is a repricing risk, but we are quite confident we will be able to pass on to the customers. I'll have a follow-up on that as well. But just before I get to that follow-up question, just one small number that I would cite from you. How much of paper do you have with mutual funds, and how is that schedule coming up? And what if mutual funds, due to redemption pressures that they are facing currently, and it is ongoing in the month of October as well, as we learn from our sources, what if they do not renew this paper or roll over the paper?
Yeah, so the outstanding as on 30th September is only 450 crores out of our total borrowings of 8,500 crores. That is number one. Number two is that we have about 1,700 crores of undisbursed bank term loan lines. So we are anyway prepared for the scenario that they will not roll over. So 450 crores repayment coming over next 3 months, over a period of October to December. Our normal repayment is repayment of our loans is about 50 crores per month. Prepayments are about 100 crores per month, so that takes care of 450. And then we have, as I told you, about 1700 crores of undrawn bank lines. So this 450 crores, even if it is not rolled over, we don't see a problem at all.
Okay. What was the last debt raising that you did? What was the cost? And you mentioned about repricing and the fact that you, or your thought that you have the option of passing it on to your borrowers, but that makes you, or any mid-sized housing finance name, very uncompetitive compared to the loans that the banks would be giving out as. So therefore, does growth therefore come into a big question mark?
Okay, so as far as the last loan that we raised was a sanction, of course, I cannot tell the name of the bank. It was sanctioned. CPs, of course, we keep on raising from time to time. So the last CP we raised was in September month. It was at around 7.86%. As far as term loan is concerned, the last term loan we got sanctioned from was from a bank, which was at around their 1-year MCLR rate. So that was about average, our average cost of funds as of today is about 8.25%. That is on the costing side. Now, as far as increase in rate and passing on to customer is concerned, yes, you are right to an extent that yes, increase in rate of interest will discourage some customers, but there we have two advantages. One is that because our funding is coming from banks and other HFC's cost is also going up, so it is not that only our cost of funds is going up. It is the lending rates are going across the spectrum. So comparatively, we don't become less competitive anyway. But yes, for the customer, it appears that average cost of funds has gone up. But there, the second advantage that we get is of low ticket size. So as far as customer is concerned, he looks at EMI amount. And since our average ticket size is only about 15 lakhs, so EMI difference is maybe few hundreds. So our experience has been, and in fact, as I told you, as compared to April, we have already increased the rate by 65 BPS. But we have seen for the first half, of course, the results will declare, so I cannot tell you the numbers. But Q1 numbers, which is already published, if we see, the sanction and disbursement were up 20% as compared to Q1 of last year. And for the half year also, we are quite confident that we will report a robust growth. Yes, as far as overall growth numbers, which we were targeting at the beginning of the financial year to be about 18 to 20%, it may come down by 1 or 2 BPS, but not a significant number. We don't see the rate hikes reaching to that level where it will discourage the small borrowers from taking the housing loans.
You're sticking.
Large borrowers, yes. Yes.
So therefore, you're sticking to what? From an earlier 20% loan book growth for FY19, you are saying it could be about 18%. You're confident of that number?
You are. Yes, correct. Okay. As of now.
Okay. The other part of my question, and while the RBI stated it mainly for some of the infrastructure names, but if indeed the ALM guidelines for NBFCs by and large are tightened, I would want your view on what could some of those measures be and how could they impact a Repco finance or a housing finance company at large?
Okay, so before that, first thing I would hope is that RBI, because when you look at ALM mismatches, as I told you, one is a contextual mismatch, second is a behavioral aspect. So I hope that RBI will take that into account. Number two part is that, according to me, of course that name everybody knows which created the problem. It was also the asset quality issues that when they have invested in infrastructure projects, those projects got delayed, there was delay in repayment. So their cash flow from asset side was under the cosh. Whereas if the housing loan, when we give, our borrowers are individuals and they repay out of their monthly incomes, which is not linked to the housing property. So the risk of default or the credit quality is very low for us. I mean, credit quality is very high. I mean, risk of default is very low. So I believe that, and I hope that RBI will take that into account. Now, as far as what measures they could be, of course, one measure could be they may cap the borrowing of CPs. Anyway, internally we have a guideline that we don't want to borrow more than 10% of our borrowings in CP. Second is that they may introduce LCR. That I think will be an issue to a lot of mid to small size HFCs, not because of the cost impact alone, but because of they don't have the capacities internal to manage those type of treasury investments. So yes, depends on what RBI will do. I fully agree with RBI assessment that funding long-term assets with short-term liabilities is a myopic strategy. But then you had to take into account the behavioral aspect also. So it will have some impact. Now what impact it will have will depend on ultimately what RBI is doing.
Mr. Gupta, you almost sounding as if the situation on the growth front or the asset quality front or the availability of finance front has not changed at all, despite a slew of changes and a change in the business scenario that we have seen.
See, okay, maybe I did not explain myself properly. Situation might have changed at a all India level because there are different types of customers. But as far as Repco home finance customers are concerned, the type of customers we serve, tier 2, tier 3 city customers for whom they are otherwise borrowing from money lenders at the rate of 16, 17, 18%, who want to have a house, who get subsidy from PMAY. For that segment, as of now, I don't see a situation has changed, but it has not changed to a situation which will force us to revise our projections of growth or NPA as of now.
Are you saying therefore that this is not a crisis, but it's a repricing?
I would say that, yes. But yes, if the interest rate continues to rise.
Okay, now please finish your point.
Yes, I was saying if the interest continues to rise and they rise by another 2-3 percentage points, then yes, it may lead to a situation where we have to relook at our growth target numbers and NPA numbers. But looking at the stand that RBI took in the monetary policy also, they have said that they have in fact reduced the inflation projection. And they very clearly said that their forecast of interest rate or interest rate action will be based on the forecast of the inflation. So if you take that into account, it seems we are either done with the interest rate hikes or there will be another 25 to 50 BS hike. If that is so, we don't see much issue for our type of business model. Again, I am repeating our type of business.
Okay, just one question, Mr. Gupta. If companies by and large move from the short-term funding model to a long-term funding model, something that the RBI said as well, that for longer maturity businesses, they should do that. It's obvious that the liability cost will be higher and therefore earnings by and large should fall irrespective of however blue chip the NBFC may be. Is that not a risk you run even if your disbursements would be at 18% instead of 20%? Wouldn't earnings by and large come off for almost all companies including yourself?
Yeah, okay. So I'll tell you about our calculation. See, today our borrowing mix, and this borrowing mix is almost constant throughout the year. It's about, I am telling about the borrowing mix. So about 15% is short term, and within this 15% short term, there is a cash credit limit and there is a CP, which is about, depending on the time and the rate available in the market, it may fluctuate from 30-70 to 70-30. But if we take the difference between our average cost of funds of short term versus long term, the difference is only about 50 to 60 BPS. So on the 15% funds, if 50 BPS cost increase happens, it's simple mathematics tells you 50 BPS into 15% is about how much? It's about overall impact will be about 45 BPS. We have already passed on 65 BPS. So that's why we don't see, if yes, the NBFCs which have 50%, 60% of short-term borrowings, they will have an issue. But if our short-term borrowings are only about 15% and we don't see it becoming zero, because cash credit limits will always be available to us. They have always been available long before CP market grew. So maybe 15% will come down to 10%. So we don't see a significant increase in pricing. Yes, 25 to 30 BPS increase will be there, but that we are quite confident of passing on.
Well, okay. We wish you all the best for that, Mr. Gupta, and we look forward to talking to Repco post the Q2 numbers as well. All the best for that. Thanks so much for joining in today.
Thanks.